Good morning, students. A very warm welcome to all of you. Today we are going to start Module 3. Module 3, Lesson 1. In Module 3, there are only 3 lessons. So all the 3 lessons are equally important. The first lesson of this is Balance of Payment. Balance of Payments. And in that, only one question can be asked, that explain the various types of balance of payment. This can be asked, or the question can be explain the concept and structure of balance of payment. So the entire topic we are covering in that. Let us start with the presentation. First, structure of balance of payment. The balance of payments of a country is a systematic record of all economic transactions between the residents of reporting country and residents of foreign countries during a given period of time. The term residents is interpreted as all individuals, business and government and their agencies. The balance of payment record is maintained in a standard double entry bookkeeping method. The balance of payment statement is vertically divided into many categories. This record is prepared to measure the various components of country's external economic transactions. The aim is to present an account of all receipts and payments arising from all economic transactions between the residents of a country and the residents of the rest of the world. The main purpose of keeping this record is to know how the international economic position of a country, which helps the government in making monetary and fiscal policy decisions on one hand and trade and balance of payment policy on the other hand. Let us see the structure. This is entire structure and this we are going to discuss. First, trade account balance. It is the difference between exports and imports of goods. Trade account balance tells us whether the country enjoys a surplus of or deficit on that account. During a given period of time, if the exports and imports are exactly equal, the balance of trade is said to be balanced. If the value of exports exceeds the value of imports, the country is said to have surplus in the balance of trade. On the other hand, if the value of imports exceeds the value of exports, we have deficit in the balance of trade. Second, current account balance. It includes export and imports of goods, visible or tangible, export and imports of services, invisible, income received and paid in the form of interest, profits and dividends, remittance from citizens working abroad, unilateral receipts such as transfer payments, gifts, donations, etc. Third, capital account balance. The capital account records all receipts and payments that involves the residents of the country changing either their assets or liabilities to residents of other countries. The transactions involved direct investment, portfolio investment, and borrowings and lendings from and to other countries. Foreign investments are divided into direct foreign investment and portfolio investment. Foreign direct investment is undertaken mostly by multinationals. They set up plants and factories on their own or in collaboration with Indian companies. Portfolio investment is acquisition of financial assets in foreign countries. For example, purchase of shares, bonds of foreign countries, etc. Capital account also include inflow and outflow under external assistance. To cover up the deficit in the current account, countries resort to borrowings. They borrow short term, which is the period of 5 years or less, and medium term and long term borrowings from the governments of other countries or international financial institutions like IMF. Next, statistical discrepancy, errors and omissions. It reflects the transactions that have been recorded for various reasons and so cannot be entered under a standard heading but must appear since the full balance of payment account must sum to zero. It also reflects the difficulties involved in recording accurately numerous transactions that takes place during a given year. Overall balance, it is obtained by adding up current account, capital account balances and statistical discrepancies. If the sum of current account and capital account and statistical discrepancies is positive, the overall balance is surplus. But if the sum of above three are negative, the overall balance is said to be deficit. Next, foreign exchange reserves. It shows the reserves which are held in the form of foreign currencies, usually in hard currencies like dollars, pounds, etc. Foreign exchange reserves, forex, are used to meet the deficit in balance of payment. A surplus or a deficit in current and capital account combined is settled by transferring to or from reserve account. So, it is called official statement. Next, the basic balance. It is the sum of current account and capital account. When the two sides of current and capital accounts are equal, the basic balance is achieved. Next, equilibrium and disequilibrium. The balance of payment always balances in an accounting sense. The total receipts of country are bound to be equal to the total payments of the country. If we include all the receipts and all the payments of the country in the account, so if we include all items in the country's balance of payments, the account must balance. There can be no deficit or surplus. When the total credits and debits of all account balance, we say balance of payments balances. Autonomous and accommodating flows or transactions. Autonomous flows take place in ordinary course of foreign trade and they are independent of other items in the balance of payments. Autonomous transactions are undertaken for their own sake, that is, for the profit they involve or the satisfaction they yield. They are voluntary and deliberate in character. They comprise virtually all exports and imports of goods and services, since they are generally undertaken directly for the profit to be made. Accommodating transactions, on the other hand, are not undertaken for their own sake. They have their source of autonomous transactions in the balance of payments, which leave a gap to be filled. Accommodating flows takes place to fill such gaps. And the last, surplus and deficit in balance of payment. The concept of surplus and deficit in the balance of payments are more clear when receipts and payments are viewed as autonomous and accommodating flows. Now we'll see that what is the surplus. Autonomous receipts are more than autonomous payments, it is surplus, and autonomous receipts are less than autonomous payments, it is deficit. Students, this is the point you have to give the answer when the question will be there. Explain the structure of balance of payment. All the points you have to cover in that. And if you can give this chart, that is also good. If you cannot, at least try giving all the explanation, because only one question is there in this topic, that explain the concept and structure of balance of payment. So here the whole answer is covered. Thank you very much.